Welcome to the Infinite Wealth Podcast. Have you been wanting to increase your banking system but just don't quite have the cash flow to do it? Well, stick around because today we've got a great suggestion for you.
Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen along with our co-host Anthony Faso, and today we're going to be sharing with you guys what we call the IBC tax strategy. Let us be clear that this is not a strategy to lower your taxes. This is a strategy on how you can use IBC to manage your tax payments and or expand your banking system over the next several years and potentially end up with some more money.
Sounds interesting. Now, Cameron, who is this for?
Yeah, there are some criteria, right? What I would say is this is for somebody that's experienced in IBC. You understand the concept, you're very comfortable with it. This is not something that we'd probably share with somebody brand new. Also someone that is looking to expand their banking system, like we mentioned a minute ago. And additionally, someone that is expecting some sort of windfall over the next 10 years or so.
Now, like a windfall, that could be a sale of a business or an asset. Maybe you're selling a rental property. Maybe that you're expecting an inheritance.
Yeah.
Or also maybe you've hit the prime age of 59 and a half.
Ooh.
And now you finally have access to all this money that was tied up in your 401k and looking for a place to put it.
Yeah. Also, I would add too is when you look at the IBC community, there's a lot of advisors out there that are talking about recapturing expenses. Our focus has always been and will continue to be purchasing assets, cash flowing assets using the infinite banking concept. But I would say this is one strategy that I would kind of consider over on the recapturing side, right? Is we are utilizing one of our largest expenses to build and expand our banking system.
Well, and I think what makes this strategy different than just recapturing expenses is we're doing this because we have a plan to repay that loan.
Well said.
Right?
Yeah.
Which is a big difference.
Completely different. And additionally, before we dive into kind of this podcast I think we do need to give the Nelson Nash Institute absolutely some credit. They have some amazing resources, but one of the resources is really kind of where we got this information or this idea from, right? Is they put out monthly banknotes. They call them, it's a monthly newsletter. They call it banknotes. Great information. But several years ago, they put this strategy out here and they called it IBC tax strategy. And so we've kind of shied away from sharing it up until this point, but we think we're ready.
And I think the reason why it took us some time to present it is whenever we are approached or come up with an idea, we always want to test it out first. We're going to do the math. And we're not going to recommend something that we wouldn't or are currently doing. And so we finally had the time to really do the math on this. And believe it or not, we created a spreadsheet.
What?
Right? And that spreadsheet, along with the math and us walking through it, we will be creating a video for that. And you have access to that if you're a member of the Infinite Wealth course.
Absolutely. So we have a supplemental video where Anthony's going to dive into that spreadsheet and geek out on all the numbers. Today, what we're going to do is I'm going to do my best to rein him in and just keep this very high level so he doesn't dive into all that stuff. So today, right, Anthony, I'm going to have you kind of jump in and set the stage here, give us some background on the situation, and then really what we're going to be looking at is two strategies. Do we start this now or do we start it later? Anthony?
All right, so the backstory behind this case was a client came to me very comfortable with infinite banking, wanted a policy of $20,000 a year in premiums.
Okay.
They are paying $40,000 a year in taxes, and he has a business that he expects to sell in about 10 years for about $500,000.
Awesome. Anthony, if we don't go down this road, right, of kind of doing what we're going to do, what's the default option for this gentleman?
What we typically do is, simply we're just design a policy for $20,000 a year. And then but we need to plan for that windfall. So what we would do is when they receive the windfall, then we would start a second policy. And what we may do to ensure their insurability, we may recommend convertible term to make sure that they can qualify for another policy.
Awesome. So we would call that kind of the start later option, right? Is, hey, we're not going to really do anything. We'll put away the savings, and when that windfall shows up, we make a plan then. But Anthony, if you could, I'd love for you to kind of dive into the start now option that you put together for the client and just run through some of those parameters with us.
What we did here is we designed a policy for not 20, but for 60,000. So, and what he simply did is, instead of paying the money to the IRS each month or each quarter, or maybe they're withholding it through his payroll, they just, instead of paying it to the IRS, they just put it in the policy.
Okay.
And then when the taxes came due, then they would take a policy loan and pay the taxes. So the taxes are paid. What we're really doing is just changing where we're storing the payment,
right,
until it's due.
Most entrepreneurs, right, some sort of checking account is where they're keeping it, right? So now you moved it in the banking system. Cool.
Exactly. And what we did, so every year we're taking a loan for $40,000, paying the IRS. Now, to make this as conservative as possible, the way that we did the math is we assumed we're not paying that loan back. We're not even paying the interest. We're allowing the interest to accrue and compound.
Okay.
So each year they take a loan for $40,000, and we add the interest on top of that loan.
Okay.
And what had happened in this scenario, at the end of 10 years, the loan along with the interest due was, the total was $500,000.
Okay.
So the plan would be is we're creating this bucket each year, so when they do sell the business, get the $500,000, they can put it inside the policy immediately, and that way it's completely liquid, and it's asset protected, and now it's outside of the tax system.
Anthony, great strategy, great overview. I do have something to throw at you.
Yeah.
Here's something to consider is, what if they don't sell the business for as much as they anticipate?
Well, that one thing is probably what had delayed us from compiling this.
Okay.
Because the strategy sounds great, but it's sometimes things don't turn out as planned.
Yeah.
And I would hate to have this great strategy, and then all of a sudden you don't sell the business for as much, or maybe you don't sell the business at all. Like you end up closing it.
Yeah.
Right. So what we did is we did the math multiple ways. One, as if we were receiving the entire windfall. But then what if we didn't receive any of the windfall? And here's one thing I want people to remember when we have loans. Remember, the loan is not from the policy. It's from the insurance company, right? We're using your policy as collateral. Now, at any time, we can change that. We can call up the insurance company and say, you know what, I actually want to take a withdrawal, and I want you to pay off that loan. So even doing that, we were still ahead of starting the policy later. Meaning, let's say they just did a policy for $20,000 a year. We compared the cash values at year 10 to doing this strategy and taking that loan and then writing it off. But so that's kind of worst case scenario, right? We were still ahead in cash value and with the death benefit.
So tangible numbers, right? Kind of the hard facts is that, hey, doing it that way, you actually still end up with more money. What are there any intangibles that someone should consider kind of along the way? Were there intangibles that you saw by doing it this way? Start now.
Well, yeah, then a lot of things started jumping out at me. And I know, and particularly when I had my CPA firm, if somebody had a good year, I'm like, okay, next year your estimated tax payments to avoid a penalty, it's 110% more than what you paid last year. And that's just a quick and easy way to avoid the penalty, right? But what I've seen is we have these good years, and then we have not so good year, and like kind of the payments kind of go up and down. And the downside is when we have a not so good year, we're paying the IRS as if we were having a good year. So the problem with that means not only do you have less money, but you overpaid the IRS, and you ain't getting that back until you file your tax return.
Yeah.
Right. So we have a liquidity issue there, but now we are in control of that tax payment. And if something happens, maybe there's an emergency and maybe you need $20,000-$30,000. Well, you got the money in the policy, so you could use it. We're going to have to pay it back to pay the IRS.
Yeah.
But when we're in a bind, there's some advantages for having access or really control.
Yeah.
Like Cameron, I know you are big on control, right? And another thing is, odds are we may have some other mini windfalls.
Good point. That's what came to my mind as you were talking, is that just as an entrepreneur or business owner, right? Typically, right, you've got several different avenues of income, right? And man, more often than not, one of those is going to pay off at some point over a 10-year period.
Yeah, even the small, maybe you're just making a little bit extra money. Or maybe the kids are finally off the family payroll, right? And you're not paying for their auto insurance and their food and all that stuff. Maybe we got an extra $500 or $1,000 a month. We're going to need a place to put it. Instead of starting a policy now or at that point, we had already started it. So we could go ahead and put that money and start repaying that loan faster.
You had said, just as we start a policy now, one of the things that I often talk to clients about as we look at illustrations is that, man, the sooner that you can get a policy going, the better you are, right? Because you get that compounding starting now, today, as opposed to delaying it into the future. And so, right, you just touched on it, but as soon as we can get that compounding started, great advantage for us.
And I know we don't talk much about death benefit, and to be honest, I think sometimes we should.
Yeah.
I think that is an important piece. People don't really want the death benefit until they need it, right? Until something happens. And doing this strategy, again, we're not changing your cash flow at all. But by doing this, having that larger policy, you're also going to have a larger death benefit.
Yeah. Speaking of death benefit, if we transition and just make some highlights or touch on some highlights for the starting later option, that would be an additional kind of downside that I would say to starting later is you've got an additional cost of term insurance along the way. Anthony, can you think of any more?
Yeah, well, I think we have that opportunity cost of that money is sitting somewhere.
One comes to mind, right, is, hey, we're 10 years older, right? If we don't have that term insurance, not everybody takes our advice and buys a term policy, right, as a placeholder for that windfall. And so if we go out 10 years and we don't have a term policy, man, you know what? Are we insurable? And if so, what's our rating going to be?
Yeah, exactly.
Yeah. The other one that I would add there is that if we start a little bit later, you can take income off of these policies. So I think this is something that we'll look at in the video. But, hey, if we start a policy 10 years from now and we want to potentially start taking retirement income off of it, is that the most advantageous time to start taking income off a policy, or is it taking income off of a policy that's 10, 11, 12 years old? Right? So another factor to take into consideration. Yeah. Anthony, we just highlighted kind of two of the strategies. Start now, start later. We've touched on kind of the several things to consider. What would you say would be the biggest advantage that you have seen kind of on the start now option or start now?
I tell you, with this, I didn't even talk about it. I kind of saved it. I'm sandbagging it.
Yeah, you are. We got a lot that we haven't touched on.
Yeah. I mean, there's really so many different advantages of here. I mean, the bottom line is doing this strategy, you're going to have more cash at the end of the day. And even if the business never sells and you never get that windfall, you're still going to be a little bit better off.
Yeah.
So I don't see the downside, but there's just a lot of opportunity for the upside. And one great intangible is when we do this, and if you see the video, you'll be able to see the difference. We have the difference of cash value in each of the strategies. But starting this policy now, we have more cash value early. So even in year 2, I think in this scenario, we had about $33,000 more. Don't quote me on there, but I know we had more than 25. Okay, and 25 can typically be the minimum down payment you need on a rental property. So what if we bought a rental property in year 2? We use that cash flow that will have paid that off by year 10 or 11. And also in this scenario, we could buy another house, I think, in year 9 or 10. So you could, in theory, have 3 rental properties that you didn't have already. So we're not even accounting about that extra cash flow that would have, the equity that you'd have in the policy, and also the tax advantages that you'd have. Cam, what was your biggest highlight?
My biggest highlight, if you look at this, is, as most entrepreneurs, business owners, is there's always cash sitting. There's always cash sitting in some account, right? Whether it's, hey, I have this money sitting here just in case, right? In this scenario, you've got that cash working for you. And so like you'd said, right, as soon as we get that compounding working in our favor, we still have access to it. We haven't lost anything, but now it's earning at a much higher rate. And another piece that came to mind was that creditor protection. We're in the state of Nevada, right? If we've got kind of loans outstanding on our policies, we got a place to put that cash if, God forbid, anything ever goes sideways on us. And so having loans on our policies is certainly not a bad thing for many of those reasons. So that's what came to my mind, Anthony.
Awesome.
Yeah.
Now, as you can imagine, this scenario, as you'd mentioned, is not for everybody, right? And so if this is interesting to you, I'd recommend that you get on a call with us and let's talk about the pros and cons, your personal situation, and see if this is right for you, of a way to expand your banking system without changing your cash flow and having more money at the end of the day.
Well said.
You know what I say now?
What?
Go make it a fantastic day.
Take care.
Thanks for listening, and be sure to subscribe so you don't miss out on the next episode. Also, check out our website, infinitewealthconsultants.com, to find our podcast along with other additional resources.